Okay, for this video, I wanted to go through a very simple tutorial on how to complete an initial year Form 1120S for an S corporation. So the example we're going to be going through, like I said, it's going to be very straightforward, just some simple income and expenses, a couple of shareholders. And so we're going to walk through the return, we're going to look at the financial statements, we're going to look at the fact pattern itself, and I'm going to go through not only the financial statements, but each part of the return and the K1s and show you how these things should be populated and completed. So I've got a couple of items in front of us. We've got obviously the 1120S itself, and I do have one slide here with the very simple fact pattern that we're going to be working with, how the company was formed, who are the owners, and some high level, what are the income and expenses. And then I've also got an Excel spreadsheet here where we've got the profit and loss for the company for the year, and then we've also got the balance sheet for the company for the year as of December 31st, 2021. So the best place to start here is certainly going to be looking at the fact pattern itself, right? So we can get kind of an understanding as to when was the company created, what's the shareholder makeup look like, and so on. That'll be our foundation to start building the return. So if we start at the top here, we have a company that's formed by three individuals. So John, Jane, and Frank decide to form a marketing consulting company in the state of Delaware. So they prepare these articles of incorporation, and within the articles it says that the company is allowed to issue 5,000 shares of Class A common stock at a par value of $1 per share. They file these articles with Delaware on March 1st, 2021. So that's the date the company was incorporated. The company then issues 5,000 shares, right? It's authorized to issue 5,000, go ahead and issues all 5,000 to three shareholders in the following amounts and percentages. So John pays $1 per share and he gets 1,500 shares of the Class A common, and he's ultimately going to own 30% of the outstanding shares. Jane receives the same amount, 1,500 shares, owns 30% of the outstanding stock. And then Frank is going to be the largest shareholder here. He's going to own 2,000 shares, which is going to make up 40% of the company. Then the company files the S election. So Form 2553 is filed to elect S Corp status, right? Because remember, this is by default a C corporation upon the initial filings, and then they decide to file the S election afterwards, and they request an effective date March 1st, 2021. So they want the S election to be effective the very same date the entity was formed, right, which is typical. The IRS receives it, they accept it, so they're good to go there. Then the company opens two bank accounts. So they have a checking account, which is the operating account, and then they have a savings account for some excess cash, just to park it there. They also open a credit card in the company name, and they begin their business operations on March 15th, 2021. Now, if we're looking at the financial statements overall here, the company generated $60,000 in revenue from marketing consulting services for their clients. The savings account generated $5 of interest income, and then overall their expenses totaled $37,005. Okay. Now, in November, they had some profits, and so they decided, well, we're going to distribute a dividend to the shareholders. So they distributed $2,000 as a dividend, and the dividend of $2,000 was distributed pro rata to each shareholder according to their ownership percentage. And just as a quick note here, for those of you that are not familiar with the S Corp structure, S corporations have to distribute everything, income, expenses, distributions, everything's got to be pro rata to the shareholders in accordance with how much stock they own, because S corporations are only allowed to have one class of stock. So it's very different than a partnership, which can allocate and distribute money in a variety of different ways that's not necessarily consistent with what ownership percentage the partner might have. S corporations, everything's got to be pro rata. If it's not, then you violate that one class of stock principle, and you could inadvertently terminate the S election, which is not ideal, right? A lot of times you do not want to do that. Okay, and then so lastly here on the return, what we'll cover is the company is going to make a de minimis safe harbor election. And what that is the tangible property regs passed a number of years ago basically say that if you're a company and you buy equipment that lasts longer than a year, traditionally you would have to capitalize that and depreciate it over its useful life. But if you buy small dollar amounts and you just decide you want to expense it currently, you can do that. You just have to make sure you include an election with your return, which confirms to the IRS that you are making this de minimis safe harbor election. So we'll cover that later on the return as well. Okay, so let's start looking at the return itself and filling out some of the basic information at the top. So this is the Form 1120S for 2021. So obviously at the top here, some basic fields, right? We have the name of the company. So we've got a fake S corporation here. The address for the company, EIN. The date incorporated is exactly that, all right? When was the company formed under state law? In this case, it was March 1st, 2021. And then the S election effective date here in box A is the same date. These dates don't necessarily always have to match up. It's very common to have companies that were formed and they were operating as a C Corp for a number of years. So you have a date incorporated and then it's only a couple of years later that they make that S election. In this case, they had every intention of making the S election immediately after formation, and so the S election effective date and the date the company was incorporated are the same. Business activity code, if you look at the form instructions, there's a listing all the way in the back which shows business activity codes depending on your industry. Fill that in depending on, as closely as you can. A lot of times there's not a good match, but just find the closest one that matches your business and fill out that business activity code there. Now, for the initial year returns, very important thing to note here, where it says for calendar year 2021 or tax year beginning. Because this is a first year return, you always want to enter the date that the entity was launched and began operations. Obviously, because the company didn't exist for the entire calendar year, so we have a tax year beginning on the date of formation, which is March 1st, 2021. And then ending on the last day of the tax year, which is December 31st, 2021. Now this, you generally only have this for the first year, right? Next year, if the company's in existence for the entirety of 2022, you're gonna have the entire calendar year, so you won't need to fill in these fields up here. But in this case, because it's a first year, we're gonna enter that information. Now, if we go down to boxes or line items G, H, I, and J, fill these out, yes or no, or indicate any kind of changes here. So G, this is the first year the S corporation was elected, so we're going to check yes for that. And then in H, you check if any of these are applicable. So if you did change your name between the time you apply for the EIN and you're filing this return, you might have a name change. Same thing with addresses. So check whatever box is appropriate. And then in item I, you would enter the number of shareholders you have at the end of the year. And this should also match how many K1s you're reporting, right? So obviously every shareholder that was a member of the company during the year would get a K1. And so the number of K1s you have generally corresponds with this number here. In our case, we've got John, Jane, and Frank. So we've got 3 shareholders. We're going to have 3 K1s, okay? Now, page 1 is the income and expense items you see on here are attributed to the ordinary trade or business activities of the company. And what I mean by that is you only report ordinary trade or business income and expense on page 1. If you have other items of income or expense that need to be separately stated, they go on Schedule K. So what do I mean by that? Let me show you the financial statements here, and I'll talk about a little more, what I mean by that. So we have the profit and loss for the company here, right? We have consulting revenue, we have interest income. If we focus on the revenue first, so the ordinary trade or business activity of the company is providing marketing consulting services to clients. So that's the consulting revenue piece, the $60,000. Interest income is an item of income that needs to be separately stated on the K1 and not included in ordinary trade or business income. So if we look at the page 1 of the 1120S here, you'll note that we have $60,000 on the gross receipt line item here, but there is no option to include interest income in line items 1 through 6. Okay, interest income is a separately stated item of income. So if we look at Schedule K, shareholders pro rata items, you'll note here that interest income has its own line item, line 4. That's where we report the interest. Okay, so we do not report interest income for this company on page 1. It's separately stated on line 4 of the Schedule K. And you'll note there's all these other items here, right? We have rental income, dividends, royalties, capital gains or losses, collectibles. All of these types of income, if you're looking at your P&L and you see other types of income that might fall into one of these categories here on Schedule K, they need to be separately stated on Schedule K. Do not include them on page 1 of the 1120S. Okay, and a very similar treatment for the expense side, right? So expenses, we have salaries, payroll taxes, insurance, and so on. But if we scroll down here and we look through these items, we find the very last item here, charitable contributions, $500. Charitable contributions is a separately stated item. Okay, so if I go back to page 4 of the 1120S here, it's page 3, you note here on Schedule K, in the deductions section, 12A, we have charitable contributions. So charitable contributions is a separately stated item on Schedule K. It is not included on page 1. Okay, so get in that mindset. Page 1 is only income or expenses that are attributed to the ordinary trade or business activities. If you have other items on your P&L that do not fall within one of these categories, it likely needs to be separately stated on Schedule K. Okay, very, very important. Okay, so if we go back to page 1 here, let's go through some of the expenses and see how these match up with our P&L. So if we look at our P&L, we've got the consulting revenue. Remember, that's being reported on page 1. The interest is not. It's being reported on Schedule K. Officer salaries, that can go on page 1. The payroll taxes, repairs and maintenance, all of these items, go ahead and enter them onto the 1120S, and they should flow through to page 1 here, right? So we've got our compensation, our repairs and maintenance, rents, taxes, interest expense on the credit card there, and then anything that is another deduction can go on line 19. You just have to attach a statement which itemizes those other items. Now the page 1 here, ordinary trade or business income or loss, should be the taxable amount, right? So line 21 here is going to be the taxable amount of ordinary business income or loss. What that means is we need to include any kind of book to tax adjustments, both temporary and permanent. So in this example, we have a very simple book to tax adjustment. We've only got one. And for those of you that have already spotted it, good job. We're talking about the client meals. So meals and entertainment expenses. Entertainment expenses recently were made not deductible at all. So if you have any kind of entertainment expenses in here, it's okay to have these deducted for book purposes, right? Your internal accounting, you can have the company pay for it. But when it comes to preparing the tax return, you cannot deduct entertainment expenses. Meals can be deducted, but you're only allowed to deduct 50% of the amount. So what we mean by that is the $200 that was paid by the company here for client meals, $100 of that is not allowed to be deducted in arriving at line 1, ordinary trade or business income. So if we look at page 1 here, the meals expense that is included in here, it's actually in line 19, we can only include $100 of that meals expense on line 19, right? We can't include the full $200 amount. So if we look at statement 2 here, I'm going to scroll down really quickly so we can find it. Okay, so here's our supporting statement for the return where we itemize those other expenses on line 19. So we have the insurance, internet, legal, and professional. And here we have 50% of the meals, right? So $100. We're only allowed to deduct 50% of meals expense. We cannot deduct the full amount. Okay, so that's what's happening here on page 1, right? We have income and expense that's connected with the ordinary trade or business, adjusted for any temporary or permanent book to tax differences. Okay, so now let's look at the balance sheet. So the balance sheet, very straightforward. We have assets only include the cash accounts, right? So again, a very simple balance sheet. We just have the checking account balance at the end of the year, the savings account balance, the liability side, we've got some accounts payable, we got a credit card payable. And then on the equity side, we've got the capital stock. Remember, we issued 5,000 shares of common stock at a $1 par value. So that was the amount contributed by the shareholders to the company to purchase the shares. And then the dividend distribution is $2,000 during the year. And then the amount of net income flowing through from the P&L for the year is $23,000. Now that we have the balance sheet amounts, let's go ahead and enter those onto the 1120S in this Schedule L section. So the 1120S, we've got Schedule L. It's page 4 of the 1120S. This is where we enter the balance sheet per books. So you'll notice here on the beginning of the year, everything is 0, right? Because the company did not exist last year. This is an initial year filing. When you have an initial year return, beginning year balances are always going to be 0. So it's just the end of tax year columns that were going to be completed, right? So we've got our cash entered here at the top on line 1, $29,900. We've got our accounts payable. The credit card payables are entered there, $3,400. Capital stock, $5,000. We don't have any additional paid in capital, but you might with your business, right? APIC is if you pay more than the par value to acquire shares, that's the additional paid in capital. And a lot of companies will have a line item there because they're paying more to get the stock in excess of whatever the par value per share amounts. And then the retained earnings number there is going to be the book income or loss for the year reduced by any dividend distributions. So the retained earnings reconciliation there can be found on page 5 of the 1120S. So it's where we have our Schedule M1 and M2s. M1 is a reconciliation of the income or loss per books with the loss per return. So as a good check here, your net income or loss per books is just that, $23,000. That should reconcile with your financial statements, right? So we have our net income or loss per book amount, $23,000. That's the amount that we see here on line 1. And then the line items 2 through 7 are all those book to tax adjustments, whether they're permanent or temporary. And we'll note here that we have that permanent difference, the 1/2 meals expense, right? So $100 represents that 1/2 of the meals expense for book purposes that we're not allowed to deduct for federal tax purposes. Okay, so let's go back to page 1 of the 1120S and take a closer look at the ordinary business income or loss line item. So after you've got your ordinary business income or loss line item here, this amount flows through to line 1 on Schedule K. So if we skip ahead here to the next, so page 3 of the return, Schedule K, pro rata items, there's that number. So $23,595, this is the amount of ordinary business income or loss generated within the company that is going to be allocated to the shareholders on their K1s. So we've got the $23,595, and you'll note here we've also got all those separately stated items we talked about. We've got the interest income, we've got the charitable contributions, and then down here in the items affecting shareholder basis, we have the non-deductible expenses, that 1/2 of the meal expense, that's the $100, and then distributions from earnings, 16D, that's the total $2,000. So all of these items that you see here on Schedule K, these are the pieces that are going to be allocated to each shareholder now on their K1s in accordance with how much stock they own. So what we want to see is that of the 3 shareholders, 30% is going to be allocated to John, right, of this amount, because he owns 30% of the stock. Jane will get 30%, Frank will get 40%, and so on down the list, right? So all of these items, what we're going to see is going to be allocated to K1s, again, in accordance with how much stock each shareholder owns. Now, before we look at the K1s in more detail, I want to touch on some of the questions that we have in Schedule B. So Schedule B, the other information section, a lot of these questions are just yes or no, but it's really important to pay attention to these because a lot of times if you are answering yes, it might trigger an additional form or schedule that you might need to file. So at the top here, some basic information, right? We're under the cash method of accounting, enter more details on the business activity of the company, what kind of products or services you're providing. And then questions 3 and 4 here, more information on the company ownership structure and what other entities it might own. In our case, question 3 is no, because we don't have any shareholders that are DREs, disregarded entities. We don't have any trusts or estates as shareholders. If you did, you would have to enter yes, obviously, and then include a Schedule B1. And then question 4 is asking, effectively, does this company own stock or other equity interest in other entities? If so, then you have to disclose those shareholdings in those subsidiary entities. In our case, no. We have a very simple corporate structure. We just have 3 shareholders. The company operates exclusively within itself. It doesn't have any other subsidiary entities. It doesn't have any other investments in other kind of companies. And then the rest of these questions, 5 through 11, right? We don't have any restricted stock outstanding, no material advisor disclosures, nothing like that. We're not making any real property, trade, or business elections. The last item here, question 11, does the corporation satisfy both of these conditions? We do, in that our total receipts are under $250 and our assets are under $250. So what it notes here is that if yes, we don't have to do Schedule L, the balance sheet, and M1. Even though we answer this yes, my recommendation is always to go ahead and complete Schedule L and M1s anyway. This just provides you as the business owner, more information about the company, and it's easier to see that the financial statements tie out and reconcile with the company if you go ahead and complete these schedules. I think it's frankly kind of lazy and sloppy when I see tax returns that leave Schedule L off completely. I mean, go ahead and complete it. I mean, you want to have these items reconciled with your financial statements because you never know who you're going to have to provide these to. A lot of banks will request tax returns, and it makes it easier as part of the loan process if they can see that everything reconciles correctly and it looks nicely. So go ahead and always complete Schedule L, M1, and M2, even in circumstances where you otherwise might not have to, because you can answer yes to question 11. So even if you answer yes, my recommendation, go ahead and complete Schedule L and M1 anyway. Okay, now the last part of Schedule B here at the top of page 4, a couple more questions. Was any debt canceled during the year? If so, you might have some cancellation of debt income. I have another video on Form 982. I'll put that in the link below. If that applies to you, you might want to include that to try to, perhaps get the income inclusion waived. Question 13, any qualified subchapter S subsidiary elections terminate or revoke? Again, we don't have any subsidiaries here, so it's an answer no for us. 14A and B, very important. If you're a company that makes payments that require Form 1099 reporting, you have to answer yes, and you have to file those 1099s, right? So if you make payments to an independent contractor, generally if they exceed $600 during the year, you would have to file a Form 1099 NEC. If you make other types of miscellaneous payments, 1099 miscellaneous, interest, dividends, and so on. So very important, pay attention to these questions here. Answer them accurately, obviously, but the idea is this kind of jogs your thinking, and you see that, and a lot of times it reminds you at year end, oh yeah, I've got to do my 1099s. Qualified Opportunity Fund, no, doesn't apply here. QOFs are certain type of investment vehicle where you can get a tax deferral and exclude capital gains on the investments. Again, doesn't apply here. We just have a very simple, straightforward consulting entity. Okay, so now that we've covered all those items, we've covered the balance sheet. Let's go ahead and look at Schedule M2, the analysis of the basically a roll forward of the retained earnings of the company. So at the start of the year, balance is zero, right? We've got a new company. We don't have any accumulated earnings to roll forward from the prior period, right? We're starting at zero. Now, ordinary income from page 1, line 21, pretty straightforward, right? Go look at page 1, line 21. That's the amount of ordinary income or loss that is being allocated or is being recorded within the S-Corp and is ultimately going to be allocated to the shareholders. And then line 3 are those other items of income that would be separately stated. So other additions in this case, we just have that $5 of interest. But if we go back to Schedule K and we take a look here, that other additions amount could include other items of income that you would see here. So let's say lines 2 through 10, whatever you might have in this bucket here could end up on that other additions line in Schedule M2. In our case, we just have the interest, so we've got our ordinary income here, we've got the interest of $5. Now we move on to the reductions. So the retained earnings is reduced by allocations of separately stated expenses, non-deductible items, and then also the distribution. So the $600 here, that's the $500 of charitable contributions, that's all on K1, that's on Schedule K rather, and it also includes the $100 of non-deductible meals. Okay, so that's where we're getting the $600 amount. Then distributions, just the cash distributions to the shareholders. So $2,000 of distributions to the shareholders. And so when we roll all this down and net out the amounts, we've got a balance of $21,000 in the accumulated adjustments account. And so this amount does reconcile with the retained earnings figure that we see on the balance sheet, right? So there's our $21,000 figure, and it matches our M2 roll forward of the accumulated adjustments account. Okay, now that we've covered those items, let's actually get into the K1s and also talk about the tracking shareholder basis. I really want to touch on that because that's something I see done incorrectly or just not at all. And it's very important that shareholders are tracking their basis. Okay, so like I noted previously, the Schedule K on the Form 1120S, those are the total amounts that are now going to be allocated to each shareholder in accordance with how much of the stock each shareholder owns. So we're going to look at the K1 for John and run through the amounts here and talk about them a bit, and then talk about how we compute John's stock basis in the company. So some of this information here is obviously going to apply to all the shareholders, right? So we have K1s here. The beginning date is, again, because this is an initial year S Corp, we have March 1st, 2021 through December 31st, 2021. Okay, now in part one here, information about the corporation. We've got the corporation name, address, the EINs up here, where the corporation is going to file this return. If you're paper filing it, you'll see an address here for a physical location, so like the Ogden IRS office. If you're e-filing it, you can have e-file there, that's fine. And then the corporation's total number of shares beginning and end of the year. Again, this is a corporation that issued 5,000 shares, so they have 5,000 shares issued and outstanding. And so all that information should be consistent across all of the K1s. Now in part two, we get into information about the shareholder. So again, each shareholder in the company is got a K1. So John here, we've got his Social Security number, his address, and the allocation of these items that's going to come through to John, right? So he's got 30% of the stock, so he's going to get 30%, a 30% allocation of all the items of income, expense, and distributions that's being reported on the 1120S. And then in item H here, we have more information on the number of shares that John owns, right? So again, he's got 1,500 shares from the company. And then in item I, we would have information here about loans by the shareholder to the company if they applied. Again, in this example, very, very straightforward. There's no loans between the company and the shareholder, so these balances are zero. Now, let's talk about some of the income allocation items here. So line one, again, this is the ordinary business income or loss item coming through from page one. So of that 25,000 some odd dollars, or whatever the figure was, let me jump back really quickly just so we can get some perspective here on this. So we had 23,595 of ordinary income or loss. That's being reported here. Ordinary income or loss, line 1, 23,595. And so what we are doing is allocating 30% of this amount to John on his K1. So if we go back to John's K1 here, that's 7,078. That's 30% of that $23,000 number. And then we go on down the list, right? We've got that interest income of $5. John's being allocated $1 of it, right? And then when we get down to lines 12 here, lines 12, those separately stated other deductions, Line 12 code A is charitable contributions. So 12A, that represents 30% of the $500 in charitable contributions. That's what's allocated to John. And then in line item 16, D and C, C and D here, 16D is the allocation of the distributions. And then 16C, we have a statement being referenced here. 16C is an allocation of non-deductible expenses. So if we look at the statement, we can see that 16 code C is non-deductible expenses, meals, right? So remember, the $100 of non-deductible meals, John's being allocated 30% of the $100, so he gets $30 in non-deductible expenses. Code 17A represents the amount of investment income, $1, because that's attributed to the interest. And then 17AC is the allocation of gross income. So $18,000 is 30% of the $60K on page 1 of the Form 1040, or sorry, not the Form 1040, the 1120S. And then 17V, other information. This is the other statement that represents information on the qualified business income being allocated to the shareholder. So the QBI amounts that are passing through, we've got our corporation here is a consulting business, so it's going to be a specified service trader business. So we have SSTB marked here. And then we have the allocation of ordinary business income or loss and the amount of W-2 wages passing through from the company. Okay, so that covers all the allocations. Now what I want to do is talk more, well, we'll start talking about and get into more detail on the basis reconciliation. So this is so very important. I cannot stress this enough. Every shareholder in an S corporation needs to accurately track their shareholder basis. So what is your stock basis in the company? Well, when you're looking at an S corporation, an individual's stock basis in the company is increased by the amount of cash they put into the company, so capital contributions. It's increased by your allocations of income, so ordinary trade of business income, other types of income. And then it is decreased by your allocation of losses, expenses, and decreased by distributions. So if we look at John's reconciliation here, his stock basis, line 1 here at the beginning of the year, is 0, right? Because again, this is a very new company, brand new company. There is no basis carryover, so it's 0. Now, the capital he contributed to the company, which he gets an increase to his basis for, is $1,500. Remember, John purchased 1,500 shares of stock at $1 par value, so he put $1,500 in cash into the company. Then we have his other increases and decreases depending on what items are being allocated to him. He gets an increase to basis for $7,078. That's the ordinary income being allocated, the interest income. So his total basis before we account for distributions and separately stated expenses is $85.79. He gets a reduction in basis for $600. That's the amount of cash he received during the year. And then there's also a decrease in basis for his allocation of non-deductible expenses and his allocation of the charitable contributions. So John's basis at the end of the year is $7,799. Now that's really important because shareholders cannot deduct losses and expenses that are passing through to them in excess of their basis. And so that's why it's so very important that shareholders track this number on a yearly basis to make sure that not only are they tracking their basis because they have to, but it ensures that if they get allocated expenses or losses or they take a distribution, that if those amounts exceed their basis, then they're either not recording the expenses or losses, or if they get cash, they have to record capital gain on cash distributions in excess of their shareholder basis. So very important to track your basis in the company. Make sure you're doing it the first year and every year thereafter. Very important. So of course we've got the other Schedule K1s for the other owners here. So we've got a Schedule K1 for Jane. We've got all of her supplementary schedules here as well. So her QBI amounts, her basis reconciliation, and then we've got that last K1 for Frank, right? So Frank, again, he's got 40% of the company here, so he's owning 2,000 shares, and so his allocations of income are going to be a little higher than the other partners, right? He's getting more of the ordinary business income, he's getting more of the interest, and he's getting more of the cash being allocated to him. Okay, so that covers the K1s. let me go back to, I think the last thing I wanted to touch on was the election for the TPP. Okay, so the supporting statements here. Where is our election? There it is. Okay, so again, when you have a company that is making purchases of equipment or other types of property that have a useful life beyond a year, the base rule is that you have to capitalize those amounts because they're assets and then depreciate them. If you're making small asset purchases, you can elect under this de minimis safe harbor election to just go ahead and expense everything in that first year you bought it. You don't have to capitalize it, you don't have to depreciate it, but it's important that you file this election with the return in order to be able to do that. If you don't include this election, then you have to be capitalizing the assets and depreciating them over their useful lives. Okay, so again, so this election, I always recommend including this, just even as a precaution. If you don't, if you think that there might be some asset purchases in there that are small, go ahead and include this election anyway. It does not hurt you. Okay, so I think that covers everything I wanted to go over with this tutorial. Again, very simple, kind of straightforward 1120S. Obviously, these can get significantly more complicated. But again, for an intro S corporation company and return, this is about as basic as it gets. I hope you found it helpful. If you have any questions, please leave me a comment below. And I look forward to seeing you again on the next video. Thank you.